Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. This week we'll be focusing on the extraordinary US inflation numbers that broke last night. 6.2% for the headline rate, 4.6% for the core, the highest numbers in 30 years. You have to go back to the early 90s to see anything like it. Some of the effects we hope will be transitory. Gasoline and car prices, second-hand car prices in particular, probably won't be repeated. But housing, some of the supply chain problems, and particularly the risk of a wage price spiral, could be with us for much longer. The impact is a global one. We've seen inflation of 4.5% in Germany, prompting a rebuke to the ECB, 3.4% across the Eurozone, and 3% here in the UK, probably rising to 4.5%, even 5% over coming months. So what does this mean for markets? Well, first of all, bonds have been peculiarly sanguine. In fact, rates are a little different from where they were 6 months ago. Can this continue? And what on earth does this mean for equity markets as they hit new highs? These are some of the issues we'll look at in the slides ahead. Thank you. Let's begin by looking at the US CPI numbers in a little bit more detail. The headline there at 6.2%, pulling up that core rate to 4.6%, a much more direct flow through than in previous cycles. On the left-hand panel, you can see a part of the reason for this was that growth itself was much stronger than we dared expect. China 8% larger than pre-COVID, US 1% larger than pre-COVID, and after the Q3 numbers, it looks though that the Eurozone at any moment will regain its pre-COVID levels. That recovery far stronger than we ever dared expect, and of course that has fed to an extent into the inflation numbers we're now seeing. Let's though break that US CPI down into its constituent parts and see what we learn. First of all, that pink component on the right hand there is transport, oil, cars, used cars, rental cars, all contributing to the largest single component of that US overshoot, and that's likely to be transitory. The red line there, housing effect, the effect of higher house prices in what they call owner equivalent rent, feeding through into the inflation numbers, that's likely to be more permanent. So is this a global phenomenon? Yes, on the right-hand panel of the next slide, you can see rates higher in Germany, the Euro area, and the UK, and they'll be trending higher even there. The Germans particularly worried about that 4.5% number and making that very clear to the ECB. On the left-hand panel, I've plotted the level of US interest rates and bond yields compared to where they were last time the US CPI was up over 6%, and that was back in 1990. 1.5% and 0.25% today, those measures in excess of 7% last time we hit this CPI number. So of course the question investors are asking themselves, is there about to be a massive bond sell-off in reaction to these inflation numbers? And is something like the taper tantrum of 2013 about to play out again? Well, on the next slide you can see that's not what bonds are telling you at the moment. Yes, they're more volatile, the US 10-year in blue, the UK 10-year in red, but in general, yields are somewhere around the levels they were 6 months ago. No sign of panic there. Yes, we see more volatility in the 2-year, the short end of the bond market, but a lot of that was down to the very botched communications of the Bank of England. Both Governor Bailey and his chief economist Hugh Pill encouraging investors to think there was going to be a substantial tightening in 2021-22, probably the order of 125 basis points, when in fact on the day they to an extent bottled and didn't put a rate rise through at all. Now I still think there are rate rise to come. I think they'll move in December and probably twice again in 2022, but the numbers are less aggressive than than investors had expected. So what do we learn from all of this? Well, I think first of all, US inflation does have some substantial base effects which will moderate. I've shown in that left-hand panel over 1 year, crude oil prices up 123%, used car prices up 38%. Those probably won't be repeated. On the right-hand side, you can see some softening already in some commodity measures. The Economist World Commodity Index rolling over, that's principally iron ore prices, brought down by a very weak Chinese economy. And there at last, some shipping prices beginning to come off as global supply chains perhaps show some signs of loosening up. The other factor that will help stabilise bond markets is simply that the supply of new bonds is much smaller than expected. If you look at the US, tax receipts are soaring as the economy recovers. This is from the Congressional Budget Office last month and shows total receipts up 18% in fiscal year 2021 over 20, which is remarkable, but even more extraordinary is they're 17% higher than they were in 2019 pre-COVID. Similar effects in the UK. In fact, we expect gilt issuance here in London to be negative for the remainder of the year up to the 5th of April. So supply a big factor helping bond markets. So what does this mean for markets overall? Well, first of all, world equities continue to hit new highs, and I think that is a little bit worrying. I think there will be upward pressure on bond yields and interest rates, and that will make markets more volatile, a little bit more dangerous. Hence our defensive, cash flow rich thematic equity content. Yes, we think bond yields will rise, but not dangerously so, but it does mean capital losses for bond investors, so we're all interested in renewables and infrastructure. Finally, we're not afraid to hold a little bit of cash on balance sheet at the moment. I think it's quite a defensive place to be until central bankers have really got a measure of these inflation numbers and what their policy spin is likely to be. Thank you.